to you and welcome to our newest episode of Capital Markets Quickie from MVP Mind Value Partners, where we present to you the most important events on the capital markets in just under 10 minutes. Hence the name Capital Markets Quickie. My name is Endrit Cela, coming at you from Frankfurt, Germany, Europe's financial hub and home to the ECB. No, wait, today I'm actually in Berlin, but like always, I have my equipment with me and always ready to record. Now, before we get started, I would like to take this opportunity to say happy birthday, Warren Buffett. The legendary investor turns 90 today. Yes, you heard it right, 90. And as I'm sure you know, he is still very active with his company Berkshire Hathaway. Warren Buffett, or as many call him, the Oracle of Omaha, is considered to be the most successful investor of all time. His investment vehicle, Berkshire Hathaway, has generated returns of around 20% per year since 1965. And that just about beats any index out there. Now let's put that into perspective. You're a 10-year-old boy and Warren Buffett is your uncle. On your birthday, he gives you $200, and of course, you're super excited to go spend that money right away. But you're not just any regular kid. You're Warren Buffett's nephew. So you decide to invest $100 in your uncle's company, Berkshire Hathaway. Over the years, you forgot that you even invested that money in your uncle's company. So now you're 55 years old and heading into retirement and finally decide to take a look at what has become of your $100. You might want to grab a hold of something because that $100 has now become over $2.2 million. Yep, $2.2 million over a span of 55 years. If you don't believe me, go ahead and do the math yourself. Now just imagine if you gave him $1,000 instead. That, ladies and gentlemen, is the miracle of compounding. And Warren Buffett is the master of compounding his and your wealth if you so decided to invest in Berkshire Hathaway many, many years ago. So for that, sir, we salute you and wish you a happy birthday and many more to come. Now back to the capital markets. There's an old saying on the stock market which goes something like, sell in May and go away, but don't forget to come back in September. Well, for investors who listened to that this year, they might be quite disappointed if they did actually sell in May. Since the beginning of May, the German stock market index DAX 30 has put on more than 24%, and the US tech index Nasdaq 100 has generated returns of over 37%. Usually the stock market, which after all is made up of buyers and sellers, takes a break during the summer months. But this year has not been normal by any means. Instead of taking a break, most people just kept on working. And that goes for Big Brother Powell from the Fed and Madame Lagarde from the European Central Bank. The money printing machines of the central banks just keep on pushing forward. And of course that was and is stock market positive. However, unemployment in the US remains high and the recovery is uneven. After a record high of 6.9 million unemployed Americans almost a half a year ago, the current unemployment claims continue to exceed 1 million per week, which is significantly more than that at any time during the major financial crisis of 2008. Another major concern is the fact that some of the temporary layoffs are now becoming permanent. The number of permanently unemployed people in the US doubled between February and July, and that of course is quite unfortunate. Furthermore, this poses a threat to consumer confidence and of course to the recovery, which makes it difficult to assess how and when the markets will further continue to develop in a positive way. But we do see some light at the end of the tunnel. Maybe, just maybe, a glimpse of hope. Now that the earnings season for the second quarter is over, we have a clear picture of how most companies are actually doing. For 98% of the S&P 500 companies that reported their results for the second quarter, the results were significantly stronger than forecasted. Let me clarify. The results were bad, but not as bad as originally expected. And that we've learned in our previous capital markets quickies is positive for the stock market. And that, ladies and gentlemen, concludes today's Capital Markets Quickie. To all of you listening from every corner of the globe, I wish you all of the best and stay tuned for our next episode on Sunday, September the 6th.